Well, hello and welcome to everyone here on YouTube. Let's jump into this. Right now we have a new opening range. Obviously the third Friday of the month was the 17th, which was the Friday just gone. So we've reset a new opening range. Write these numbers down: 4081.51 and the lower number is 4047.95. If we're above that, we're in bullish range mode. For the market. If we're below that, we're in bearish mode. Now, if we do break above the upper number I just mentioned, we're probably likely to come up and fill this gap up here at 4218. If we break the lower line, we're probably likely to come back to that significant trend line that we've had in place since the beginning of last year, right here. So we're likely to break here if we break the opening range to the downside and move back down to this very important trend line. If we do break that, obviously further downside will occur. That's around, if we do break the lower range, probably around 3,900 on the SPX is probably the next place where we will go to. Now, as far as our market internals that tell us where the market's likely to go, the total or the combined put call ratio right now, the 10-day moving average is 0.93. That's neutral, not really telling us enough or telling us anything right now, either one way or the other, bullish or bearish. The skew is the perceived risk of a market crash, right? A 2 standard deviation move or more to the downside. Right now that's at 123, so that's neutral as well. The SPX put call ratio though is below 1.75, so that is bearish, shows excessive call buying, and that is actually bearish. The trend at 1.12 is neutral as well. As far as market momentum goes, the amount of stocks above their 50-day moving average is almost 70%, so that is bullish. If we have a look at the risk appetite of the market, just have a look here at these key moving averages, which are the 8, 21, 34, 55, and 89, all of them exponential. Now, if we look at the risk appetite of the market, we look at the junk bonds, we can see that the price is below all of those moving averages, so that is bearish. And even if we look at high yield bonds, the risk appetite there is not very good either, so that's certainly bearish also. If we look at something like Goldman Sachs, so goes Goldman Sachs, so goes the market. That is actually bullish. So what I'm trying to say right now is we've got a new opening range. So we don't know how that's going to play out until Tuesday, because remember the markets are closed on Monday for President's Day in the United States. So we don't really know what's going to happen there yet. So we don't really have a clear indication of bullish or bearish right now in the market. So you want to be very conservative with the trades that you're taking, not take a lot of risk, or even just sit on the sidelines for this week. Now, last week we had the CPI number came out, the heavily manipulated CPI number. It was 6.5% inflation last time we measured it year over year. Now it's at 6.4, so come down slightly. But if you look at the CPI or the CPI number month over month, it's actually gone out 0.5. Right? And even core CPI month over month has gone up 0.4%. Now, the little bit of a surprise was the core producer price index and the producer price index month over month. Both of those were up more than expected. As you can see, the PPI month over month was up 0.7 compared to the expected 0.4. So that was a bit of a shock, and that does give you a bit of an indication as to where CPI will likely move. So not great news really all round, but the markets have held up okay. This week will give us a lot of clarity as to where we're going to head next, no doubt about that. Now, as far as a potential idea, right, if you had to get into a trade this week, I was looking here at Google, right? GOOGL is the ticker, right? Now, I'm using a 9 and a 21 EMA. I can see the 9 is crossed below the 21. We've got the MACD, we can actually see here the MACD line is crossed below the signal line, so that's bearish as well, and it's above the 100. The histogram is showing there's a pretty good difference between the signal line and the MACD line, right? So that could indicate a bigger move down. And we've actually got a bear flag, right? It's from around 105 approximately down to around 95, right at the bottom there. So if we do break that level, right, out of this bear flag, we're likely to move another $10 to the downside, which would coincide with this low here. That is a high probability that could happen, right? So that's a potential idea. The other thing that you could see from there, I'll just show it to you here on this chart, it's a little clearer. You can see that there is a gap to fill down here at 88.67 right there, right? So there's a gap to fill if they do break out of that bear flag. Some pretty good volume coming in here as it did break down, so it'll be interesting to see. But I'm looking for this to move to around $90. Don't want to take a lot of risk, right? Move to around $90, or at least come down to fill that gap at about $88. Okay, that's what I'm looking for. So having said that, what type of trade could you do? Well, you could set up a bearish put debit spread on Google, right? So type in Google here, right? I'll just show you the whole process. Google. You guys wanted me to educate you guys on the actual strategies and how they work. Don't have to take a lot of risk. So the 17th of March, 27 days from now, okay? Now, right now trading at $94.35. So I'm going to set up an out of the money put debit spread, looking for it to move down to fill that gap at 88. Okay, so the ask, you click on the ask at 91, okay, and you click on the bid at 90, right? So what's the goal here of this trade, or the aim? Well, the goal of the trade is for the stock to move from $94.35, where it is now, to below $90 come the 17th of March, 27 days from now. We are going to pay, well, 11 cents is the bid, 41 is the ask. In between those two would take us to 26, right? So $26 a contract is what we're risking. And the potential upside is 74. So our potential upside is $74 for one contract, and the maximum risk is $26. Okay, so that's pretty good, right? So you could have 10 contracts risking 260 to make 740 if Google does in fact go below $90 and stay there up until expiry, the 17th of March. Okay, if we're wrong and all of a sudden Google has a huge rally to the upside, then we'll lose $26 a contract. Right? So it depends how many contracts you're going to take, but it works out to an 285% return on risk. The amount of return you would get for the risk you're taking is almost 2.85 times higher. Right? The return's 2.85 times higher than the risk you're taking. So that's a pretty good deal. Now, with the risk being only $26 a contract, I'm not going to put a stop on this. Okay, I'm going to monitor this. I'm going to monitor this each day and see how it goes, and then I'll just manually close this out. Normally, I would do these as set and forget, where I would set a stop and a profit taker, right, called a bracket order, all there at the same time. But for this particular one, with a relatively low risk, I'm willing to just place the spread as it is. So that's a potential idea for this week, and you know, not a huge amount of risk, but a pretty big potential upside if it does move below $90, right? So that's a pretty smart way of doing it. Out of the money put debit spread, not taking a lot of risk. Don't have a clear opening range yet in the market. We don't have any of our market internals giving us clear indication what the market is likely to do next. As a result, we don't have a high probability setup. So when that happens, we look for edges, which is the bear flag, which is the MACD crossing down, which is the 9 crossing the 21, which is a gap to fill, right? All those edges with a particular stock, and then we set up a risk to reward that is asymmetrical in our favor, right? 2.85 times higher the reward than the risk we're taking, right? And then that's what it's all about. So I hope you guys enjoyed that. Just going through that very quickly. I'll do more detailed education like this if you want me to. Let me know. You can send an email to support@cashflowoptions.com.au. I hope you guys enjoyed that. I'll talk to you again next week. All the best. Bye for now.